Hi folks, this is Ch3. Welcome to a new video of my forex trading course. In this video I want to be talking about the importance of reading price action around the area of support and resistance, especially when price enters in a period of consolidation. Okay. As I was mentioning on the course, when we have a clearly trending scenario, price is bound to eventually retrace back to the area, to the dynamic area of support and resistance, to the moving averages. All right, every swing is formed by two waves. One, the impulse wave in the direction of the main trend, and then you have the retracement, which more often than not, if the trend is strong, it usually gives way to a whole new impulse, okay, in the direction of the moving averages, followed by yet again another impulse, another retracement wave, etc., etc. Okay, the stronger the trend is, the more following impulse and retracement waves we will have, one up on the other one. Okay, it all depends how strong the trend actually is. What's important is to read price action once the price has actually retraced back to the moving averages. Okay, once the retracement wave has concluded, okay, price comes back down to the dynamic area of resistance, and from that, as I always say, it's a decision-taking area. There are two possible outcomes: either a price bounces off it in the direction of the main trend. Once the retracement is concluded, the bulls show up in this market once again, and therefore a whole new swing springs out, okay, from this area. Or the other possible outcome is that the dynamic area of support doesn't quite hold the retracement, the bulls fail to show up, and from that, price breaches the dynamic area of resistance, of support in this case, since we're in an uptrend, and therefore, it's a clear signal that the trend is actually weakening down. Okay. The reason as of why this happens is twofold. Okay, firstly, there are two events that take place at the same time, they basically leverage each other. All right. Like I'm saying, when we have a clear uptrend and price retraces back to the moving averages, okay, once the retracement impulse concludes, and then therefore price retraces back to the dynamic area, there are two possible outcomes, as I was saying before. Okay. Now I want to be assuming that since we've already seen and we've already determined what happens when the bulls actually begin to show up on the retracement, and therefore price begins to take off in the direction of the trend. We've already reviewed that in previous videos. Now I want to be talking about what happens once the bulls actually fail to show up on the retracement, on retracing back to the dynamic area, to the decision-taking area. What happens if the bulls fail to show up? All right, in this market, as I was saying before, there are two events that may take place at the same time, and they leverage each other. Okay, they basically strengthen each other. Right. First of all, it's what's usually called in the market the bulls panic. All right. Basically, all the people that have been long in this trend, okay, there are people who entered here, anywhere along this trend, they've been making money. Okay, they are in the money. They've been holding their positions. Perhaps they've been adding upon every retracement. They've been adding to their long positions. Okay, and therefore building up their onto this trade with further lots, okay, with further contracts in this particular trend. Well, once price retraces back down, they are ready to, if price turns around and the trend proves itself that it still is valid, this is still strong, and they will be more than ready to load up long again and keep on building their long position on this trend for as long as it lasts. Okay, that's what most of the long-term investors, actually large investors such as banks, hedge fund managers, etc., that's their main trading strategy. Right? You've probably heard before the concept of buy and hold. Okay, it's basically you spot a trend, and at every breakout, at every new swing, you buy and hold your position. You buy once again and hold. You buy and hold as long as the trend lasts. Okay, once the trend begins giving signals of weakness, well, you exit out all your positions. All right. Well, when price actually fails to continue with the trend, like I'm saying, the bulls panic shows up. Okay, all the people who had been long in this market perceive that this is a decision-taking area, and any possible breakout to the downside will be basically taken as an early warning of weakness in this trend. So what they do is they are very quickly to close down all the positions that they've been opening all along. Okay, all their long positions in this trend. As soon as the breakout takes place, they close down their positions because they don't want to give all these profits. They don't want to give all these profits back to the market. Okay. Profiting from trading is difficult as it is, and the last thing you want to do is, once you are actually in profit, is to give them back to the market. Okay, so at the first signal of weakness, like I say, all the bulls fall in panic, and they close down all their positions, and therefore propelling down price against the trend. Okay, as the more long positions are closed, price speeds up to the downside. Okay, and the second event is actually the opposite one. The bears, the people who wanted to sell short this market, they see this their opportunity, perhaps a trend line breakout, something like that. Okay, and at the first breakout, they join short in this market. Okay, basically what they are identifying is the end of this trend, and they've been waiting for a long time for this trend to finish, and once the breakout actually takes place, they say, all right, this is my chance. I am reloading short. Okay, I am mortgaging the farm, and I'm betting on a bear market from now on. Okay, in my opinion, in their opinion, this uptrend is finished, and once the breakout takes place, okay, once it's confirmed that the trend is actually weakening, they reload short right there, and therefore, just as we saw before with the bulls panic, these new short positions speed the drop down in price, and therefore it's usually what you see is quite a heavy momentum. Once the breakout actually is confirmed, what we see is a massive acceleration against the trend. Okay, or what it had been the trend. Now this trend is probably broken, and therefore it's not strange to see a massive red bar, okay, such as this one. Okay, because those two elements I was just saying before, those two reasons, they strengthen each other. The bulls get out of this market, and the bears decide to show up. All right. So like I'm saying, usually when price retraces back to the dynamic area of support, when we see basically an indecision around this area, the bulls and the bears are battling each other. They are trying to decide whether this trend should continue or break. The outcome is rather momentum filled. Okay, whichever way it's supposed to go, the outcome will take place in momentum. All right. So now that we've spotted this last swing, okay, the retracement back to the dynamic area of support. Sorry. Let me zoom in now into the what would be our trigger chart, which is in this case the 4 hours time frame. I am showing you this example because actually I was looking to try it myself. All right, this actual setup. In fact, if we draw some trend lines, we can see that the retracement part was actually a flag. Okay, actually, let me go back into the 1 hour time frame. All right, we had a clear flag formation, which we saw the flag formations in chapter number 2 of this trading course. Here is the pole of the flag. Here is the flag in itself, all right, and I was looking to try a breakout to the upside. Okay, so looking into the 4 hours time frame, which in this case it was my trigger chart, we identify the flag formation. It's a very clear flag formation, all right, with multiple swing highs, okay, topping out at the flag stop, and multiple swing lows, bottoming out at the flag's bottom. All right, basically I was waiting for my typical breakout pullback continuation pattern. Okay, very typical formation. In fact, I was searching for an entry right above this level. Okay, this is the breakout, this is the pullback. You see that? You see up on the breakout pullback pattern. From there, I was seeking to try the continuation. I had my buy order in this case right there. About 10 pips above this swing high. But in fact, what price did actually, if we have a closer look in the up on the breakout in the following days, price had basically been moving sideways. Let me mark that sideways price action in blue in my screen. There's the top of the sideways range. That's the bottom of the sideways range. Okay. Up on the breakout and the pullback, price began to move up, okay, but they just could not breach through breakout from this sideways range, which in fact it had been in place for 1, 2, 3, 4 days, 4 days in place. All right. Upon this breakout and pullback, price was it was time for price to begin, for the bulls to begin to show up in this market. Okay, the trend was clearly up in the setup chart. Moreover, the retracement flag, okay, the retracement channel in the trigger chart had been broken and had been retested from above. It was time for the bulls to either show up or die. All right, there was no more, hesitating about, no more messing around. It was either push price in the direction of the trend, or well, basically you are giving green lights for the bears to take control of this situation and bring price down. All right. In this case, the bulls basically failed to break up on the breakout of the retracement trend line to break this sideways price action. All right, I am sure many buy orders were placed around here, around this area, and once all the people who were looking to enter long in this market, once they saw that their buy orders did not get triggered, I am sure many exited once they saw that the actual breakout took place to the downside. If they had been long in this market, I am sure many of them closed down their long positions at this level, and have a look what happened. Bang! Price fell about 200 pips within 1 day. Very heavy acceleration against the main trend. Like I was saying, that probably means that firstly, many long positions were closed out at this level once they realized that the breakout to the upside didn't quite happen. Okay, once they realized that there were the bulls didn't have any momentum left, any gas left in this market to keep pushing up. What they did is they basically closed out all their positions there, and price, bang, fell down 200 pips to the downside. And second, the bears that were waiting to enter in this market. This was their opportunity. Once they saw the fake breakout, okay, that well, not the fake breakout, actually the breakout did happen, but they could not go through the continuation of the actual breakout. That was their signal to basically they realized this breakout had fizzled away. Okay, that's why it's always so important. I always mention that's important to wait for the breakout, pullback, and continuation aspect of the breakout, because the continuation aspect of any breakout is what actually confirms the breakout in itself. Okay. Trading the fast breakout is always very risky because you don't know whether the breakout is is solid, is actually a strong breakout, or is just basically a half-assed breakout, such as we've seen in this case. Okay, what you want to do is you want to wait for the actual confirmation, place your buy order there, and if it does happen, if the continuation actually takes place, you know that there will be many buy orders, buy stop orders around this area, pushing price in your direction. Conversely, in the other hand, if the continuation fails to happen, expect a heavy drop against the trend due to bulls panic and due to bears showing up in this market. Okay, those two reasons I was mentioning before. That's why I always say that the dynamic area of support and resistance, once price in a trending scenario retraces back to the moving averages, it's a decision taking area, and from that we are to determine, well, the market is to determine whether the trend will continue or whether the trend will weaken down significantly. All right. Always keep an eye, a close eye, follow price in real time. Once the retracement back to the dynamics to the dynamic area has actually happened. Well, because you will have clear indications, okay, whether this trend is still strong, whether you want to still be looking for long entries, or whether it's time to realize that this is not looking good anymore. Okay, the bears are now showing more strength. They are stronger than the bulls. The bulls have sort of chickened out, okay, failing to break to the upside. They've basically chickened out, bailed out of this market, and they opened the doors for the bears to charge in and regain control of this market. Okay. Alright, folks, that's basically all I have for this video. To recap in a little bit, keep an eye on price action around the area of the area around the moving averages. Sorry, more often than not, it will give you a clear indication. Once you become comfortable and accustomed to price reading, they will give you early signals of whether you want to still be looking for trades in the direction of the trend, or whether the trend is actually weakening and the dynamic area is giving way. Okay. And therefore, once this happened, okay, once this breakout took place, in my opinion, as far as I'm concerned, as a trend trader, remember that in the setup chart, the trend was clearly up. As a trend trader who only trades in the direction of the main trend, once this happens, okay, once the breakout didn't quite give way, the only decision for me to take as a trend trader, once again, was to cancel the whole setup. In fact, like I say, up on the breakout pullback, I was waiting for price. I had my sound alarm placed up there in order to, to search for a long entry at this level. Once I saw that price failed to take out this high, I was beginning to get very nervous about this setup anymore. It was not quite looking good anymore. Like I say, once price failed, we had few different days. Actually, let me zoom in a little bit so you guys can see how price topped out at that level quite a few days in a row, actually 4 days in a row. This was Monday's price action, this was Tuesday's price action, Wednesday, Thursday, and well, as the breakout happened on Thursday, it was a clear signal that Friday was gonna be a bear's day, you know, a bearish day. It was very clear in my opinion. Once I saw actually that on Thursday price failed to break above all these highs, okay, the high for the week, which was the 147.50. In fact, if you want to go back into my blog and read my entry for this day, which was the 11th, I think it was the 11th, actually, let me see, the 11th or the 13th. It was the 13th of December 2007. If you want to go back to my blog and read that entry, you will see how I mentioned on a live video that price was failing to take out this level, the 147.50 level, you know, which was had been the top, the highest point for multiple days throughout the week. Price just could not breach through, and I stopped consider any long entry in this scenario, because like I say, things were not looking good anymore. Okay, there were no momentum whatsoever to the upside. If there had been bulls enough to, you know, buy orders enough in this market to push price to the upside, it should have happened already. Okay, it should have happened already. When price begins to meet up on a breakout, okay, always remember that in my opinion, a breakout must be a clean breakout, then you have the pullback, and you must have another clean continuation move. If instead of that you see price moving sideways for days upon days, in this case 4 following days in a row, beware. All right, let the warning alarms, the warning bells warn you in advance, because something is not quite right in that setup. And like I say, once I saw price breaking in momentum, have a look at that momentum bar, that long red bar in the second half in the New York session of Thursday. I knew for a fact that the Friday was actually going to be a bearish day, but I don't trade against the trend. Is one of my main rules. Actually, it is indeed my main rule as far as trading goes. So I decided to, you know, not bet short on something that in my opinion was very clear. I knew, like I say, I had all the indications that this breakout was going to fizzle away when I saw all the week long this level working as resistance, and price not being able to breach through any of the days. Okay, once the breakout took place to the downside, it was clear in my mind that, you know, we were to see on the following day a momentum drop to the downside. But anyway, I do not trade against the trend, so, you know, I did not consider that possible entry. But anyway, guys, what I'm trying to say here, what I'm trying to point out is the importance of price action reading again around the dynamic area of support and resistance, and how it usually can, you know, warn us in advance whether we are about to enter a sound position in the direction of the main trend, or whether the trend is actually weakening. Price breaches through, and from that, you know, the whole setup is cancelled. Okay. Alright, folks, that's all for this video. As usual, if there is anything you don't understand, please feel free to send me an email. I will very gladly give you my feedback. Okay. Bye bye.